Hello and welcome. You're watching Business Today Television. I'm Tanya Aneja. Well, the contribution of passives to overall assets under management has been consistently rising in India. Experts believe that passive investments are comparatively more attractive than active investments because of ease of investing, better liquidity, and lower cost. So, in this episode, we are going to discuss passive investment strategies, evolving landscape of equity ETFs, index funds, and much more. And my guest on the show today is Mr. Anil Ghelani. He's the head of passive investments and products at DSP Investment Manager. Thank you so much, Anil, for taking the time out and joining us here on Business Today Television. And I think we all know that the contribution of passives to AUMs has been consistently rising. But how do you differentiate between active and passive investment strategies, and which strategy, according to you, is better suited for the current market conditions?
You made it very right that today, as we look at the overall mutual fund industry, passive investments, that is like ETFs and index funds, have risen considerably. Today, we have close to about 16% of the total assets under management, which are the passive strategies. Couple of years back, this number was barely 4 to 5%, at which point of time the global number was around 10%. Now, in absolute terms, though we are still small, in percentage terms, we have far overtaken the global number. And what we believe is that in the next couple of years, this is set to increase with the overall increase in the penetration of mutual funds in India. Now, if we look at the one or two key reasons why I believe that ETFs and index funds are rising, is that point number one, we are seeing a very important element whereby in especially large cap universe in India, the active managers are finding it difficult to outperform the benchmark. So because of that, investors are trying to look at alternatives whereby they can get access to low cost and simple and easy to understand ETFs and index funds for taking the allocation. And second reason linked to that is the simplicity and ease of understanding. So how I see it is that, let's say for somebody who is first time investor in capital markets or who does not really know much about mutual funds, this becomes a very good starting point or entry point whereby without any much understanding of how the fluctuations in the capital market happen, without any much understanding how to select the fund manager or the scheme that will have the potential to outperform in long period of time, one can at least get started and get exposure to the market. So hence, I feel that as we look towards enhancing the penetration of mutual funds, ETFs and index fund will be the first starting point and continue to grow because of this reason. Now, your second point, what we believe is a good strategy in the current market situation. Well, I think currently in the overall equity markets in India, currently we are in a position, we are in a situation where there is bound to be some bit of increased volatility and some kind of, I would say, we have seen in the last about 19 months, a broadly range bound market where the Nifty 50 as a broad indicator of the large cap universe of the overall market, uh, it had seen its highs around 19 months back. After that, little bit movement, but it has remained broadly in the similar levels that we are seeing today. So, in this kind of a range bound type of market, I feel it can be good to get exposure to passive funds. So, in the current market situation, if you were to allocate your large cap money, I would suggest to go towards passively managed ETF or index funds. And for some allocation to small caps or some tactical allocations, definitely go for active funds.
Okay, absolutely. That's the word coming in. And talking about index funds only, Anil, they are also grabbing a larger share of investor money, I think. And these funds have witnessed a sudden rush of inflow also in the month of March, because I think investors want to take advantage of indexation benefits on capital gains. And I think it's the only category which recorded month on month asset expansion also during FY23 among all MF categories. So your thoughts on this particular space, and do you think it's the best form of investment at this point in time?
See, basically, if you look at index funds, And these flows number that you talk about for March especially, there were two categories, distinct categories. One is debt mutual funds or debt index funds and ETFs, and the others are equity or commodity based. So in the month of March, as you might recall, towards the end of March, there was a announcement of tax law change whereby fixed income oriented schemes would soon get short-term capital gains tax even if the holding period is more than 3 years. So there was a sunset clause for that of 31st March. Hence, during the last about, let's say, two weeks to like the 10 to 15 days of March, there was a very sharp rush towards debt funds overall as a category, debt mutual funds, and within that, debt index funds as well. After that, March is gone. If you look at the data of, let's say, April, and then May data is now just getting released, uh, of course, we will see continued flows in the equity category. But in my view, the sharp spike which we are seeing in the March, because of which even, let's say, FY23 number is looking high, that will sort of normalize, at least for the medium term. Gradually, people will align to that also, that even though there is a taxation which is going to be short-term taxation, which somewhat aligns the taxation of debt mutual funds or debt index funds with other similar instruments like FDs or bank deposits, etc. So gradually it will realign, flows will restart in this category, but maybe in the near term, we will see less flows into this category of debt index funds. But the other part, the other category of equity index funds, that in my view will still continue to see ongoing inflows and investor interest.
Okay, absolutely. And also ETFs for better performers, I think, than actively managed equity mutual funds in 2022-23. So, your thoughts on this evolving landscape of ETFs?
See, I believe that there are certain cycles and certain pockets of market in which we keep observing these cycles. So, for example, large cap as a universe. In the large cap space, there was a cycle during the previous decade, let's say the decade from 2000 till 2010 period, whereby actively managed funds were significantly outperforming the benchmark indices. Or let's say the ETFs which track the benchmark will have similar performance. So the actively managed funds, one can assume, were comfortably outperforming the ETFs. But in the next decade, the period from 2011 through 2021, or like now, the period after that, we have seen a cycle change whereby the actively managed funds in the large cap space were finding it extremely difficult to outperform the index.
Okay.
Two key reasons for that. One was the way in which the definition of large cap stocks had changed as per the SEBI guidelines, where it was very prudently announced that only top 1 to top 100 companies by market cap will be defined as large cap, and any fund which is classified as large cap needs to have minimum 80% in this 1 to 100 companies. So earlier, whereby in large cap, many mid cap, small cap also were included, that slowly reduced. That is one thing. And second, I believe important thing is been the way in which technology has changed everybody's lives. In terms of research in companies, information being spread. So all of these, at least large cap stocks, got too much of research and coverage easily accessible on the fingertips at very fast speed for everybody. So the potential for active manager to outperform in this category, in this space, reduced over time. And because of that, people started shifting to ETFs for large cap. That is how I look at it. Uh, uh, so now, yes, in this recent couple of years, if you look at the actual numbers and data, we will see that certain categories, certain actively managed funds have outperformed the index, but it is also very difficult to identify which will be those actively managed funds. And because it's difficult and because the divergence between the best performing active managed fund and worst performing active managed funds is so wide, that investors find it difficult that which fund should I select? If I unfortunately select the worst fund, then I will be suffering. So I'll give example with specific numbers. And if I see being equity as an asset class, let us look at long-term performance. Now, if I see 10-year return, like since you mentioned March, we track this data on fiscal year to fiscal year. So 31st March, I think we had tracked this data, and we had seen 10 years back. So the worst performing actively managed large cap equity fund had delivered CAGR return of close to about 8.5%. Relatively good number in over long period, 8.5 CAGR. But the best performing large cap equity fund had given almost 2 times, means around 15.5% returns.
Okay.
So if you had unfortunately selected the worst fund, which maybe at that time was doing good, but sitting today it has become the worst performer, you would be facing an underperformance of around 7% CAGR over 10 years. It's a huge number. Whereas Nifty 50 during that period had given return somewhere in the middle, I think something like, around 11%, 12% like that number, not the top, not the bottom, but around 12% type of number. So if you would have selected an ETF or index fund which is tracking, let's say, the Nifty 50, then your return would be somewhat in that line, basically, some percentage here there because of tracking error and tracking difference. But at least you would not be having the tension that, well, what if I was the worst performing active fund? So because of this, that performance divergence amongst active funds has been very wide. Historically, it was definitely a good performing cycle for active funds, but that has been changing recently over the previous decade versus current. And because of these reasons, we believe that it is going to be more and more prominent that people will prefer, especially in large cap space, to go for passively managed ETFs and index funds, and they will be in a position to do better.
Okay, absolutely. Got that. And since you are with us, let's discuss Indian markets also. So, how are you approaching markets at this point in time? I mean, Sensex reclaimed the 63K mark today, again in Tuesday's trading session, and Nifty is also not far away from its all-time high. So, how do you pick your bagger stocks and I would say wealth creators?
Sure. See, I'll try to highlight slightly different angle. In my portfolios that I manage, I don't try to focus on individual stocks or multi-baggers. I try to look at overall market, like we just spoke, basically because of the huge divergence and all, and the push towards like ETFs, index funds, passive overall, by the beta of the market, rather than trying to worry about alpha, which can be difficult or sometimes very divergent. So for that, I'll just give a good framework in which I am looking at markets today. I like to call it CFE. C for corporate earnings. So I will start with that particular first part, C, then F for flows, and E for event risk. Now, you very perfectly mentioned that, let's say, today Sensex or today Nifty is almost back to its all-time highs, basically.
Right.
And if we recall in history, all-time highs were earlier seen during the 2021 of October, November, basically around Diwali time of 21, and we are back to around those levels. So this around 19-month period, we have seen that the top level market has been in the very range bound, and it has been in the similar position now today.
Right.
So returns in this like about 19 months, 20 months have been flattish. But during this period, the corporate earnings or the company profitability has grown very well by around 30% from that period till now. So if you look at the Nifty earnings, basically, or the EPS of Nifty 50, 12-month rolling period, during this October 2021 and now, it has risen by around 30%. So because of that, now my Nifty level or Sensex level has almost come back to the same. Earnings has also increased. So what it has resulted is lower valuation or lower P2E multiples, P2E is price to earnings multiples, price to book multiples, which makes us feel that market is in a more relatively attractively valued levels. So this is the first and foremost, that how the corporate earnings have grown in a good way in this last 18 to 20 months. Now, the next part is the flows. So, crucial to keep in mind that today, like you mentioned very correctly, that mutual funds itself have been growing. There has been healthy flows in mutual funds. Whether we look at SIP flows, which has been consistently increasing, touching around 14,000 crores per month of SIP money, but there has been some outflows also. So there is a little bit net flows wise movement, but still there is a constant flow. But other than domestic, like mutual funds, like NPS, like insurance companies, there is a foreign flow also, which is very crucial and important. And there, what we have seen after last year, calendar year 2022, which was pretty negative, and there was a large outflow of foreign investors. In the last 2 to 3 months now, we are starting to see a good comeback on that, and we believe FPI, foreign investors, have turned positive because of the valuation comfort, like we spoke earlier. So I believe in this current remaining months of the year, we will continue to see good, healthy flows from FIIs into equity as well. So this is the second part, like basically corporate earnings flows. So both of these are in a very good position, that it gives us the comfort that flows will come. Domestic flows is also robust. Foreigners have started further interest in the turn, and earnings is good, so it looks relative valuation wise attractive. Now the third thing is the E part, or what I call as event risk. So CFE, corporate earnings flows, and third thing, event risk, which we need to keep in mind. That is something which, if you look at certain global developments, look at how the geopolitics is playing out.
Right.
There could be certain instance which could come out of the blue, which could cause a disruption, or which could create some kind of a event risk for the overall markets. Some of those things are little bit analyzed by market participants. Like for example, if we feel that there could be consistent pressure because of the side effects of the sharp interest rate hikes in some of the countries which we have seen. Historically, we have hardly seen such a sharp hike wherein let's say in the US, we saw huge rate hikes in the last about 11 months, and which most of the current countries followed. So if there is a side effect of that on certain sectors, it could be resulting into negative impact because of the way in which it will shoot up prices of certain inputs, raw materials, etc. Certain corporate profits margins can be under pressure. So this particular thing is a huge overhang at how this side effect of interest rate hikes will play out, how some of the global geopolitical risk will play out. Sometime, of course, it is important to also keep in mind that on a hindsight sitting today, many people can think that yes, this war situation whereby Russia invasion, well, it was seen, it was everybody expecting. But mind you, going to the history, before the actual date when it happened, everybody was thinking, yeah, well, I mean, it's being done, but nobody was expecting actually invasion and war. Likewise, there are certain situations where very often market participants feel that, yeah, well, this will definitely get resolved by then, basically, But you need to be conscious and aware, basically. These are what I like to call as grey rhino events, basically, Divergence, but grey rhino is a concept popularized by this author, US-based author, very prominent, Michelle Booker, in a book that we need to be clear about this kind of risk which can come up. So this is important thing I like to keep in mind anytime I'm observing markets and where the money should be allocated.
Absolutely. Thank you so much for explaining it so well. And on that note, thank you, Anil, for taking the time out, sharing all these wonderful insights with us. Thank you so much.
Thank you very much. Okay.
So with that, let's wrap up this special edition, but do stay tuned for all the latest market updates. And thanks for watching.
If you like the video, do like, comment, share and subscribe.